Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He takes a look at how they did the past week and so far this year. He also examines crude, gold, the U.S. and Canadian dollars, and Bitcoin. BC brokerage business veteran Victor Adair gives us his views on how the Russia-Ukraine crisis could affect the markets, gold, currencies, and interest rates. He also talks about investor psychology. Rick Ackerman, publisher of Rick's Pick, says for all the talk about Russia-Ukraine, there has been little reaction from the markets about it. He gives us what he believes are some key targets for the Dow, gold, silver, and crude. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartSpy. Ross, welcome back to This Week in Money, Ross.
Always a pleasure, Jim.
Ross, how did the markets do this week, and how have they been doing so far this year?
Well, let's see. This week was kind of the example of what the year has been, down 1.5% depending upon the index for the week. And most of them closing, now they've given back better than half of the bounces that they had after that initial panic into the end of January. But you look at the sectors once again. It's the Russell 2000. It's the Nasdaq 100. Not the top 10 stocks there, but as you move down through the list, the ones that are really shy in terms of having any earnings and any PE ratios that one can look at, still indicative of the 2000 to 2001 market that we correlate this to, and I don't see any reason to change. The recovery rallies are just retracing back to reasonable resistance levels in all of these indices, not just one or two of them. You take even the Dow, which had a much better overall appearance here. I mean, the Dow from, say, May of last year is basically unchanged. Big rounding top, with this bounce from late January into 10 days ago. But good overbought readings on the short-term oscillators, like the relative strength, just feeding now more to the downside. One of the comparisons we're doing is this action in the equity markets together with what we're seeing over in the bond market, very much like the 1994 market that had a pretty steep correction at this point as well. And the first break, you end up testing near that support level. So somewhere around the 4,300 level as far as the S&P is concerned would be a decent spot to look for a bounce. I wouldn't be at all surprised that we bottom out the early part of next week and have a rally off of that.
What's happening with crude?
The crude oil market has had this, great advance, put in some upside exhaustion signals in the first week of February, a small pullback to around 88 and change, and then pushed up towards 96. So we've had really no follow-through on that first rally, and we're back to testing the $88 level during the second half of this week. That is a pretty important support level for us. In this phase of what we look at as a big 10-year cycle in the crude oil market, this one started from April of 2020. The phase that we're in here is a rally that typically lasts 2 years, maybe plus or minus a month on either side. So somewhere between here and let's call it the end of May, we should be looking for an ultimate top. And supports along the way should be around the 21-day moving averages, which is what we've kissed this week. So a rally out of here into new highs, still thinking up around 103 is a good target there, is what we'll be looking for. And the key to watch for will be pretty much the low area that we had this week around $88.
What's happening with our precious metals?
Precious metals bottomed out with silver and gold on the January 27th and 28th when we got the springboard buy signal simultaneously in both gold and silver. Now, those rallies will typically take you up for a period of 2 to 4 weeks. So we're 3 weeks into that run right now. And I would expect, and we had in the middle of the week a sequential 9 sell setup, so that's 9 consecutive bars with closes above 4 bars earlier. And typically what happens there is that you'll have a pause. Usually it's anywhere from 1 to 4 days. It'll come back and test the short-term moving average, which we did as we got down to 1850. And now we closed off the week back around 1900. The optimum here would be probably a rally into the 1920 to 1940 range next week, and anticipate that from there we could get a pretty decent correction back once again under 1900. But I would think maybe closer to the bigger support down around 1840ish. And of note here, since that last bottom at the end of January, the miners have been outpacing the metal, both in terms of the silver stocks and the gold stocks. This is really good for the long-term picture, but on the short term, a lot of these issues, once again, are starting to show some excess on the upside, and most of them had a pretty good pause at the end of the week as the gold market has found a little overhead resistance at 1900.
What's happening with the U.S. and Canadian dollars?
U.S. dollar still has this small upside bias to us. It hasn't had any really bad hits, and on the week it had a pretty decent move. The better part of what do we got? 50 basis points here, closing at 96.02, and I would suspect that that trend is still to the upside. And considering that we still have that positive bias, it's interesting to see how well the precious metals did during this last couple of weeks, because it's been fighting a reasonably buoyant U.S. dollar in the meantime. On the other side of the coin, Canadian dollar, with the action we've seen not only in crude oil, but if you take a look at the whole CRB index, so that includes the grains and the base metals, etc., that index just continues to barrel along on the upside without any participation by the Canadian dollar. So this is a pretty bad omen as far as the dollar is concerned. So if when the eventual correction comes, as far as the CRB is concerned, the Commodity Research Bureau index, I would expect that the Canadian's going to get a real hammering on the downside.
What's happening with cryptos?
Crypto, didn't talk about that last week. It's been pushing up from a good capitulation low and ended up with resistance pretty much where you would expect at the 44,000 level from where it had broken down. And it's moved with pretty much all of the other markets now, easing from that February 10th high, closing off the week just under 30 or just under 40,000. And there's probably a good chance of a retest of that key support level back at 37.5, but or 32.5. But I at this point, I don't see any reason to be participating in there other than just a day-by-day basis. The kind of capitulation we saw back at the bottom, let me just check the date here. Yeah, that was the 22nd of January, where it was the capitulation low down at 35,000. And pretty good 10,000 point rally to 45 pretty much run its course. So I think just look for this as more of a chattering market with support still probably, 2,000 or 3,000 below where we closed off the week this week.
Ross, thank you so much for the update.
It was always good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsPyRoss. Coming up, Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. His website, victoradair.ca. Welcome back to This Week in Money, Victor.
Jim, always good to talk to you.
Boy, we've got some increasingly tense times around us. Russia, Ukraine, the Olympics end this weekend, and who knows if China might decide to move into Taiwan just to celebrate the end of the Olympics. And then we have the long weekend in both the U.S. with President's Day and Family Day in Canada. So how are the markets handling all this tension?
I think there's a thinness in the market. I mean, this past few days, I've seen the markets really, by the markets I'm talking about the futures contracts on stock indices in particular, just jerk around, like in response to any little headline or whatever. As you know, by far and away the majority of the trading that actually happens, and you got to put that in scare quotes, is machines. So they're just picking up headlines off the news wires and, buying and selling markets. So it's been choppy. I mean, just to stay with Ukraine, Russia, it is an existential risk, I think, and I have no idea how to handicap that. We have a lot of military personnel and hardware from Russia on the border, not only the Ukraine border, but in Belarus on another border with Ukraine. I can't even begin to pretend to be any kind of a military analyst or a political analyst as to what can happen. So, to go full circle, in so much I see choppiness in the market, what am I doing? I just have to say, with my objective with trading is to try to make money and keep it. It is so easy in this kind of an environment to say make a bet, and it's a very binary bet. And you want to bet, that the Russians will go in with a lot of hardware and whatnot, and there will be a serious conflict. I mean, how the hell do you price that? I mean, you think, gold would go to the moon, the stock market would go into the basement, and let's say the U.S. dollar would probably be bid. So, but then if that doesn't happen, it might. So there's some pricing, Anyway, existential risk, I think there's just a wonderful opportunity here for all kinds of misinformation. So for me, I'm just saying, okay, I'll just have to live to play another day. I can do a woulda, coulda, shoulda, they went in there and I'd have made a fortune if I'd have bought this or that. I'm basically watching, rather than trying to participate in this sort of an environment. And that's just, the risks of Russia, Ukraine, let alone the normal day-to-day risks that we have.
Central banks appear to be switching gears or talking about switching gears, even though the Fed is still buying billions in bonds and mortgages every week. What are the markets expecting from the Fed?
Okay, so the Fed has had extraordinary monetary policy since the COVID panic in March of 2020. Coupled with that was extraordinary fiscal policy from the governments during the same period of time. So just a tidal wave, a tsunami of capital went at all kinds of markets, whether it was real estate markets or these tokens and different kinds of crypto coins, stock markets, whatever, everything. It was a wild time. And now we're starting to sober up a bit. The governments appear to have a lot less leeway to keep spending money. The central banks, let's say, my opinion would be that the Fed stayed too aggressively easy for far too long, and maybe part of their rationale, as they talked about last summer, was that inflation was just going to be transitory, and now it's like, oops, well, maybe not so transitory. So the market kind of thinks the Fed's behind the curve. That's pretty obvious. What does the market think the Fed's going to do? They think the Fed's going to raise rates. So the market reaction is, the forward contracts, for instance, and all kinds of instruments, we're pricing the Fed increasing interest rates by, let's say, 2% or more over the next 12 months or so. We're seeing credit spreads widen. So when interest rates were going down, the premium that people would demand from riskier credits got smaller and smaller and smaller. If you can get practically nothing by putting money in the bank, and you want to lend money to your deadbeat cousin or something like that, instead of charging them 10%, you only charge them 5%. But of course, you weren't going to get paid back anyway, so it didn't matter. Credit spreads, they got narrower and narrower. In a way, you never know what's the cart and what's the horse here. But the Fed may have just let the market lead, and then the Fed can follow along. My good old friend Bob Hoy, and I know he's on the show a lot, I think, without putting words in Bobby's mouth, I think he would take that view that, it's the market that leads the Fed, not the other way around. But yeah, the market is expecting the Fed to stop buying all those bonds and mortgages and actually sell some of them back or let them mature, and to raise interest rates. There would be what I call eloquent spokesmen who would argue that the Fed will be very aggressive, and other people who say that the Fed will just get started, the market will have a hissy fit, and the Fed will freak out and ease or stop their action. That would be called the Fed put. The Fed wants to protect the market from having any kind of a bad hair day. So that's where we are. I'm probably getting a little too flip. It's pretty serious stuff here we're dealing with, but at some point in time when I sit in front of these screens for long enough, you just say, well, it is a gong show, and you try to make the best of it.
Well, I recall about 2 years ago, the Fed, when they thought inflation was underperforming, they said if inflation does take off, we have the tools to deal with it. Well, so far they've kept all those tools in the shed.
Yeah. Will
they actually bring out those interest rate hikes that the market, I think, perhaps might have already priced in?
It's the $64 trillion question is timing, is when. I think we may have actually seen in August of 2020 was the lowest interest rates basically in human history. And so to say that we may be rising from there isn't much of a call, but we probably have seen the lowest interest rates that we'll see in our lifetime, and the rates will go higher. I don't know that we're gonna see 15% yield on government bonds like we saw during Volcker's era. Although some people who are of the Weimar persuasion would say that the bonds won't be worth the paper they're printed on, all that kind of thing. Whatever. That's too far into the future for me or my trading horizon. I just think that, the Fed will be pushing interest rates higher, as will other central banks around the world. That's pretty much baked into the cake here. Unless, we have COVID number 43 comes along and we go back into lockdown, blah, blah, blah.
Gold is up $120 roughly from the end of January to a 9-month high of $1,900. What do you make of gold and gold shares here?
Let's start the other way around. The gold shares have been for months and months underperforming gold, and they've kind of popped up. They're still relative to where both of them were a year ago. The gold shares are still underperforming bullion, and I think that basically the rationale for that, the stock market's been getting clobbered here and there, so gold bullion is seen as the safer hedge rather than gold shares. But the magic with the gold shares, of course, is the leverage. This is in gold producing companies as opposed to companies that have got a gleam in their eye that someday maybe if everything works out they'll be producing gold. For the gold producers, as the price rises, unless their production costs are just skyrocketing, their profit margins increase, and they're able to get priced off of that as well as the risk premium that goes with owning gold. But okay, to go back to gold, $1,900. Yeah, I mean, in the past few months here, we've seen gold pop a couple of times, and we've seen the speculators come jumping into the market. It certainly happened back in November when we rallied, I don't know, about $80 or so. The speculators come charging in there, and then as gold fell back to where it had come from, they all threw in the towel, and I would imagine lost money on balance. But this time, it's like this time it's real, and you can draw lines on a chart and say, see, we broke out of that trend line and so on. And besides, the existential risk of Russia, Ukraine, so it creates almost a buying panic. And the fact that, the stock market's been weaker since the beginning of the year after hitting all-time highs back beginning of January. And while the stock market was going up, gold got ignored. So now the stock market's going down, maybe gold, catches somebody's attention. I think it's difficult to buy it here at $1,900 with my kind of time frame. I think there's easily, $60 worth of risk in it, and I wouldn't want to buy gold and see it go against me $60 and still be holding it. So I've missed this jump up in gold. That I've missed a lot of trades in my lifetime, and one of the things that is painful is when you get FOMO, that fear of missing out, and just decide you've got to lunge in because it's going higher and you just can't get left behind. And then when the market starts to go against you, you have a hell of a time trying to figure out whether or not you want to stay with it. So it's just not a good setup for me to buy here, but I think it is clearly a reaction to the geopolitical stress in the market. A couple of other things that affect gold, which are, negative interest rates and, say, a weak U.S. dollar, have not been contributing factors to the run-up in gold. So this is very much, I think, an inflation hedge as well as a geopolitical hedge. Whether or not it sustains itself, I don't know.
West Texas crude rallied for 8 consecutive weeks to a 7-year high of $95 a barrel. And I see California gasoline prices hit record highs around $4.75 a gallon. Here in Vancouver, we hit record highs, the most expensive gasoline in North America, at just over $1.82 a liter, or about $6.95 per U.S. gallon. What's driving the energy markets, and what do you see ahead?
Certainly in the very short term, we've got a geopolitical risk premium in crude oil. One of the things that tells us that is the backwardation in the forward market. In other words, right now, let's say we've got, just for round numbers, we've got the front month crude oil trading at $90 a barrel. The year forward crude oil is trading $14 a barrel cheaper than that. That premium of the front month over a 1 year forward is the biggest premium we've seen in years. Now, certainly, if oil was trading at $30 a share and $30 a barrel, and we had a $14 risk premium, that would be a different case because of your base effects. But there is a huge risk premium in the market. So let's say if you could just remove the worries of Russia invading Ukraine and the fallout that might come from that, if you could just take take that off the calculation, then I think crude oil would be somewhat lower. I don't know what it would be. Is it $10? Who knows? Certainly not $50. The thing that's really driving the crude oil market, and this is pretty well documented, that's sort of a case of, who doesn't know this, but we get tight supply. And the prospect of demand increasing as, all around the world, COVID is in the rearview mirror more and more, so there'll be this reopening of economies and a surge in demand. That's what's anticipated. Spare capacity is awfully skinny. Probably, let's say 3%. If we go on a base of 100 million barrels a day getting consumed, if we've got 3 million barrels of spare capacity that could come online quickly in the event that, somebody sprung a leak somewhere, then things would be scary tight. So that has been, I think, the driving story. Why do we have that? Well, we've got, 2 years ago, for instance, the energy complex was the dog of the stock market. They were the worst performing thing while everybody was chasing tech. This past year, energy was the hottest thing on the board, and so it is carried on that way here in January. But years and years of underinvestment. Well, certainly one of the reasons for underinvestment is if you and I are senior executives in a oil producing company and we're looking at spending $1 gazillion to develop a resource that is going to start to give us payback 10 years into the future, given, all the time it'll take with permitting and everything else to actually get the thing to be paying off. But then we look 10 years into the future and think, well, maybe the ESG boys will have just closed it all down. So we can't afford to commit that money. So there you have it. Underinvestment means we haven't developed the demand, the supply, that to meet the demand that we're going to have, and the demand continues to increase. The safety valve is price. Price goes up. That's grossly simple, but that's certainly a big part of what's been driving the prices higher.
The Dow Jones and the S&P hit all-time highs the first week of January. Since then, it's fallen, bounced back, fallen again. The Dow now down about 3,000 points, about 8% from January's highs. What are your thoughts on the stock market going from here?
Well, it's been, let's just stay with the short term for now. And by short term, I mean, the next month or two or so. We did hit all-time highs on those two indices the beginning of the year. The NASDAQ had hit a high, I think, back in November, and it was a little weaker already. We've talked, I think, before on the show of the internals of the market. Yeah, the indices were really strong because, there's a handful of stocks, the really big cap stocks, the Apple, the Microsofts, the Googles of the world, that sort of thing, that were so heavily weighted in the stock market and it's so heavily owned. While meanwhile, the companies that you never heard of, they were already down 10, 20, 30, 50%. So the indices were holding up while the internals of the market or the broader stock market was weakening already. That's that side. On the other side here, I see that I look at the flows. Retail capital keeps flooding into the market. I think in January, we had an all-time record flow of retail capital into the equity markets. I could be wrong on that, but that's something I've read and paid attention to lately. Corporate buybacks were huge last year. Look, could be even huger this year, so buying there. So risky growth stocks, the tech stocks that maybe someday will do something, but in the meanwhile are just burning dough like there's no tomorrow. They've been battered. There's been rotation, things like that. I was just truly amazed to see a company like the Royal Bank of Canada. Their share price jumped, it seemed like 20% in a month. So, this capital was rotating out of some stuff and going into other stuff. Energy markets were very strong. Financials were very strong. I also see that, just I saw this morning that, it was yesterday morning. One of the indices metrics, I should say, I really pay attention to is bullish psychology in the market, and this is a combination of institutional money and retail money, is at a 6-year low. I mean, we just hit all-time highs, 6 weeks ago, and we've come off a bit, and people are disappointed. I think that if the Russia-Ukraine situation was to go away, stocks would jump. Whether or not we make new all-time highs or not, I don't know. But right now, for me, the real story is capital inside the market is switching from sector to sector, and that's really much more important to me than just the indices being, up or down from all-time highs.
The U.S. dollar hit 18-month highs in January, up about 9% from January a year before, but has fallen back slightly. You've been bullish on the U.S. buck during all of our interviews over the past year. Are you still bullish on the greenback?
Maybe, yeah, and I think maybe even last month I was a little bit, I'm not so sure anymore, and I'm still kind of in that camp. The highs that the U.S. dollar made in January were, I think, really very much on the back of the idea that American interest rates were going to be going up much more quickly, much more sharply than interest rates in other countries, and that was kind of a premium for the U.S. dollar. On a longer-term basis, capital flows to the United States for safety and opportunity. And the American stock market had been the hottest stock market in the world, really, other than maybe, some country like Venezuela where people were buying stocks because, you couldn't buy toilet paper. The rise in the stock market drew that capital in, and there may be a shift going on where capital is starting to say, okay, maybe it's time to take some profits in America and reallocate to other places. The European Central Bank surprised everybody when they kind of opened the door to raising interest rates this year. The European Central Bank has been much more aggressive than the Fed in terms of like a percentage of GDP with building their balance sheet and flooding capital into the markets. One of the things that's happened as a result of that is that I talked earlier about the premiums of different quality credits. So the spread of Italian paper over German paper really went out, as the prospect of the ECB not being there to buying everything, hit the market. So with the U.S. dollar, I think it probably right now has got a bit of a risk premium in it. I mean, if you see gold and the U.S. dollar both doing well at the same time, that tells you the market's worried in simple language. And I think that's there, and you can't take the Russia-Ukraine problem, existential risk, out of the market. It's just there. So by default, do you want to make a major move into the European currency right now if you're an American? Probably not. But if the situation or the potential risks in the Ukraine were to diminish, maybe there would be capital that would move from the American markets into the German markets or what have you. So I'm a little neutral right here on the U.S. dollar relative to most currencies, in a general way. So, yeah, I've been bullish. It's been a good run. For the U.S. dollar to continue to go higher, I think we'd have to have stress and worry in the market, and, of course, that's never far away.
The Canadian dollar's been trading in a very narrow range between 78.25 and 79 cents American for the last 3 weeks. Even though crude prices continued to increase, are political developments in Canada hurting the loonie?
I guess we had to get around to that sooner or later. Yeah, Canada's been dead in the water, really, for the past month or so. But then all of the currency markets have been relatively quiet. I mean, there's been some chop in the euro. Certainly the euro jumped on the ECB, looking to maybe raise interest rates later in the year. As we've talked before, there's a kind of three major things that impact to Canada. That's the relative strength or weakness of the U.S. dollar. So the U.S. dollar's kind of gone sideways, so that's done nothing for Canada. Energy is a big deal, or commodities generally, but particularly energy within the commodity complex. That's been a real win for Canada. But then on the other side, the stock market being weak, maybe down 10%, say, on the indices from the all-time highs at the beginning of January. That is a negative for Canada. Relative interest rate policies sometimes important. I don't think so much that important right now. So then it comes to the last part of your question, political developments in Canada hurting the loonie. As much as I would think so, so far, no. However, and you could hear that coming, if the policies that the government has put in place this week were to be seen by the rest of the world as something that's going to stay in place or grow or become more draconian, I think that would have a very detrimental effect on the Canadian dollar relative to the U.S. dollar. I think you would see, let's give you a situation, a comparison. The Swiss franc has always been kind of a go-to currency in Europe. I've talked years and years about, picture a German who is worried about government policies in his country, and he's got some money. So he puts it in a briefcase and he slips across the border into Switzerland, in the moonlight, and gets some of his money safe. And whether it's the guy in Germany or, the rich folks down in the Middle East or whatever, people have been squirreling away money in Switzerland for years for exactly those sort of reasons. I think Canadians, if they saw that these kind of policies were going to remain in place for some time, would move capital out of Canada. I think foreigners would be shy about moving capital into Canada. And that would not be good news for the Canadian dollar vis-a-vis the U.S. dollar. So far, I think the market figures that, and it pains me to say this honestly, but I think the market figures that this will blow over. I think that's what the market is pricing, despite, some of the conversation you might see on some of the channels of information. But if it doesn't blow over, it's going to be a hell of a problem. So that's my answer.
I guess Canadian flag sales really have gone up the last few months all over the planet.
Well, Canada has, in an unusual way, captured the world's attention. God bless us. We are, in a wonderful country and all that sort of thing. We're blessed in so many ways. But I think the rest of the world figures Canadians are pretty dull. So, yeah, the truckers' convoy is being copied all over the place. But it is just, I think whether it was with you, Jim, or I know I've said this recently in some interviews that COVID's over. And I know I had some friend got in touch with me and he said, "You're absolutely wrong. People are still dying." And I said, "No, you don't. I understand that. That's not what I mean. When I say COVID's over, the market is looking ahead. COVID's actually not even in the rearview mirror anymore." And so that's where we are in the markets, looking ahead. And the tone is, we got to just put this behind us. Doug Ford, the premier of Ontario, was saying this week. And of course, as I say, it pains me to say this, to see here in the province of British Columbia, our government wholeheartedly supporting the policies that brought down in Ottawa, while the other Western Canadian governments, and of course Quebec, basically saying, "No way, Jose." So, yeah, I don't want to go too far down this rabbit hole. I think you can sense how I feel about it.
Interest rates rose sharply in December, January, and early February, but have steadied this past week. We're not talking about the central bank rates, which are totally different. These are the ones, I think, that are influenced by international bond sales. Has the increase been because of the Fed or inflation or both?
Yeah, that's kind of the horse and the cart again. Inflation has clearly been rising, and that's not, inflation in financial assets I'm talking about. I mean, we're seeing inflation in all kinds of things. I guess the tricky thing here is, whether the inflation that we have is something that the Fed could do something about. I mean, if you have inflation in the price of hammers because all the hammers are made in China and the boats that are bringing hammers to the United States got into trouble, so we don't have any hammers, so people bid the price up, the supply chain issues. The Fed can't do anything about that. I suppose, draconian-wise, they could try to raise interest rates to the point where the economy cratered and then people wouldn't need hammers anymore, but that would be dumb. That's not going to happen. I think the Fed was too easy for too long and kind of stuck to their guns with the transitory story and then made a pivot. And now they are going to reverse those policies. And certainly their transitory view on inflation was wrong. I think they've admitted that. Not to put words in their mouth, but I think that's obvious. So yes, it's the Fed is reacting to inflation, and they will raise interest rates. Sorry, Jimmy, maybe I'm not really getting to the heart of your question. Here's something that is important, and that's what I call the rate of change. I mean, I think the market sensed, last summer and certainly early last fall that the Fed was wrong on the transitory idea. But interest rates were only kind of inching higher. Then we got into December and the bottom started to fall out of the bond market. And then we got into January and short rates just started to really smoke to the upside, and the yield curve was flattening like crazy. So the rate of change, the speed with which interest rates were rising sort of compounded itself. You can appreciate this is a phenomenally huge market, and there'd be people with positions in the market who were betting that, interest rates have gone up and they're not going to go up anymore, and then they surge higher, and those guys are all wrong, and they have to bail out of their position, and that sort of creates the falling dominoes effect in the market. So I think we had that falling dominoes thing in the tail end of January and the early part of February, and that seems to have quieted down now. We had, say, the yield on the 10-year bond went through 2%. Now, if the stock market was to be weaker, if things were to heaten up or get hotter in the Ukraine-Russia situation, I think the American capital markets, the interest rate markets there, would definitely catch a bid and yields would come down as capital is trying to find safety. So there may be some of that, too, that's putting blunting the rise in interest rates right now.
In the February 12th edition of your trading desk notes on victoradair.ca, you made a rather bold forecast. You said that the American equity market may have made a long-term top in January and that you expect a significant correction, something more than 10 or 15%. Could you elaborate on that?
Yeah. And I've thought that for some time. I mean, accompanying that forecast, and that was in on my radar section of the notes, I had a chart of the stock market going back, let's say, more than 15 years or so. And when you look at it that way, you see we had almost a parabolic rise, particularly from the lows in 2009 to where we were at the beginning of January. In this was I think the S&P 500 chart. It was up like 120% from the March of the COVID lows of March 2020. Like, we've had a hell of a run. And that's just the numbers on the stock market. But we've had this attitude, what I would call bullish market psychology. People who thought it is easy to make money in the stock market. You just buy stocks and they go up. And if you're not doing it, you're an idiot. And people that weren't doing it were thinking, they got the FOMO. Gee whiz, I'm missing out. Look at my neighbor's driving a brand new Rolls Royce and I'm still walking to work, because he's in the stock market and I'm not. That kind of thinking. So I think people came piling into the market, and in terms of piling in, more than half of the new money that came into the market was in the form of passive investing. Whether you're doing it yourself, online with a online package and you're buying ETFs that just invest in the market as opposed to trying to pick stocks. And I think this is particularly more popular with the millennial generation than with boomers. I'm not saying it's wrong. I'm just saying this is what is. And I think with passive money, they subscribe to the view that you're in for the long haul. You know, you just look at the stock market chart for the last 100 years, and you can see that there's a few blips here and there, but basically it's just gone up like crazy. So get in and get rich. I think the passive thinking would be you need to just continue to put money in on regular intervals. Let's say once a month you're putting money into the market, so you kind of average out, and there'll be dips and doodles and so on, but don't worry about those little things. The market only goes up. So at some point, I think that doesn't work anymore. And it may be that we made a major high in January or not. I don't know. I just think that if it was, and we start to go down from here, some people will decide to sell. I think the passive folks will wait quite a while. I think it'll take more than, say, a 10% decline for them to, like we had in January, for them to become sellers. They'll just see that as a buying opportunity. But if the stock market is down 30% and more, and it's been down for 6 months or more in a row, some of those guys will start going, gee whiz, maybe is it possible that this isn't working? And gee, I was counting on that money to do something with it. So gee, now I'm in a problem, and actually I borrowed money to buy that stuff, and now, and so on. So then you start to get, the domino, tumbling phenomena where the weak hands start to sell, and that makes people that might have held on, then they start to sell, and so on. So that's what I see. We had this incredible run, and over the years, I've been trading markets for 50 years, and I've certainly forgotten more than I ever remembered. But, you just see charts where the market runs up like crazy, and everybody knows it's going to be, the next greatest thing. And then sometime later, maybe a year or two, whatever later, it's not in the headlines anymore, and it's way down from where it was. And that can happen with individual issues, so that can happen with the whole broad market. And I think the key building brick there is investor psychology. So far, folks believe that stock market only goes up. And if they ever start to think different, it'll already have been down some distance, and that's when they'll be selling. So we have these cycles. And that's a possibility. I put it out there, as you might say, in my notes as something that I think about, and it's been building for a couple of years.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a real pleasure to talk with you. Thanks for having me on.
My guest has been Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still a very active and knowledgeable trader. Check out his website, victoradair.ca. Coming up, Rick Ackerman, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Rick, are you talking to us from Florida?
I am. We're having a nice wintry Florida day, not exactly a beach day, but thanks as always for inviting me on, Jim.
Rick, does it look like Dow hitting 33,150.33 in January could be a significant bottom?
I don't think so. I think the market is in a topping process. I'm looking at these hidden pivot patterns that I use to project, and the jury's still out. I'm going to keep an open mind. But let me give you a very specific number in the Dow that so you can know what I know when I know it. I'm looking at a Dow chart right now, and let me see if I can get the coordinates right on this so I can keep your listeners well apprised. All right, so we're headed down off a recent bounce. It bounced from the number that you just mentioned all the way up to 35,824. And the key number here on this correction is 34,100 and, well, let's see, trade stations really always, it's a battle to get the right number. 34,142. Okay, so you can take that to the bank if you want to bottom fish, because even if the market goes lower, we're going to have a tradable bounce from within 1 angstrom of that number. It's what I call a midpoint pivot, and it's a great place to monitor price action. So if the Dow comes down to that number and absolutely pulverizes it, it means that it implies more slippage to as low as 32,460 in this particular cycle. So again, the key number to watch is 34,142. If it doesn't even get down there and rallies to take out that last high at 35,824, then it's going to be off to the races again. We'll be looking at Dow, well, certainly new record highs.
What's driving it? Because, as you said, it seems the market doesn't care about the potential major conflict between Ukraine and Russia.
Well, it's not earnings or the headlines or anything else. It's just the limitless torrent of money that's being pumped into stocks. Where else are you going to put it? The Fed has put so much liquidity into the system, and even at today's very high prices, you can't spend it all on groceries. So it's just going into the markets. We're having an asset inflation here simply because easing has proceeded to an extreme.
If the Canadian Truckers for Freedom are successful in opening up the economy, what could it mean for markets?
I'm not even caring much about that. What I think is most significant about that whole episode is that it's made it very clear that the whole world stands behind the truckers, and that Trudeau is out of his mind. I suppose in the same way that America got what it deserved when it elected Biden, Canada got what it deserved when it elected Trudeau. But you can see that he's almost alone there in his lunatic stance as far as the suppression of they don't have First Amendment rights, but of course a lot of people in this world believe in them. So there's been such an overwhelming and nasty effort to stomp out this trucker insurrection that they've made a lot of friends, and I think it's going to be part of what will later be seen as a turning point in the geopolitical trend toward one worldism and wokeism and all those other isms that make our lives so much worse.
Now, you would think that the possibility of a major war between Ukraine and Russia would have more of an impact. Why hasn't it?
It would definitely be a shooting war, and I guess one of the reasons these are people shooting at people that they know. I mean, they're not just neighbors. People who live in Ukraine and Kiev, they've got kin in Moscow. So it would be a horrible war in the human sense. But there are a lot of things. It's not unreasonable to speculate that Putin has just been bluffing to see what concessions he can get from Ukraine, and of course one of the key ones is that Ukraine not join NATO, and it looks like Vladimir has more or less clinched that part of it with not much in the way of opposition from the U.S., Germany, or anybody else.
Well, the Germans sent, 5,000 helmets? That's their aid to Ukraine? That's it? Yeah.
Yeah. I mean, what are you going to do? I guess, if they gave them real aid in the form of, let's say, a nuclear, something with a nuclear payload, then I guess we'd all be worried. So we should probably be happy that the aid came in the form of 5,000 helmets.
Well, Ukraine gave up its nukes in exchange for a promise from Russia that Russia would never be aggressive and invade Ukraine, and we're seeing how that's working out so far.
Yeah, well, Putin obviously had his fingers crossed.
Maybe the Ukrainians kept some of their nukes and we don't know. That would be dangerous for the whole world, wouldn't it?
Well, you got to remember, they're Europeans. Europeans don't use nukes. We kind of suspect who would out there in this world, but it's not going to be some Western European country.
What about China, Taiwan? Is Ukraine, Russia just a warm-up for that?
Yes. Yes, it is. And to the extent that I won't say the market's thumbed its nose. It's kind of hard to read the market's reaction to Ukraine because I think the market would be in a topping process. It's in a topping process now, regardless of the news. So the idiots who interpret the news in the mainstream, the legacy publications, all say each and every day, well, the market was up because of optimism concerning over Ukraine, and then the next day it's down and they say it was pessimism. But that's all those hacks know. They don't really understand the markets. So the market is just sort of doing its thing on a basis of cyclical forces that have been in play since the 1700s, or since markets have existed in the U.S. And when Taiwan gets steamrolled, the world should be embarrassed, or at least the Wall Street should be embarrassed, because it's probably not going to make much difference either. But again, we're in a topping process, so that an invasion of Taiwan by China could just coincidentally occur at the same time that the stock market, by dint of those cyclical forces, was headed back to half of its, retracing to, in the case of the S&Ps, to the 2000 level or whatever.
While we're talking, on the 17th, gold had a nice pop. Do you think it's going to continue?
Yes, I do. I've been using a target. I hate gold. You know, it's been for years just so good at disappointing traders, but or long-term investors. But as much as I hate the stuff, or hate the way it trades, we've been using for some time a very bullish price target at $1,916.40, 1916.4. That space is the April COMEX contract. All right, and so it's that was signaled back in July, by the way, or early August. So I use these technical method really just to keep me objective, and objectively it's been going to 1916.40 for a long while. Now, the interesting thing about that number is that it's closely coincident with a key, what I call an external peak at 1922.40 that was made back in May. And if it blows through this 1916, especially if it closes for 2 consecutive days after it hits it, it could, I would take it as a sign that maybe the long correction in gold is over. And that's what it's been doing. It's really been taking its sweet old time correcting what is a longer term bull market. So a push through 1916, especially a close above it, and above that interesting May peak at 1922 could signal that the move we've all been waiting for in gold is finally here.
What's the story for silver?
I've got a somewhat higher projection for silver. I'm using a similar pattern, but it's a little bit more ambitious. My minimum projection is $26.12 for an ounce. That bases the March COMEX silver contract. Is currently trading $23.83. So percentage-wise, there's more of a move there to get to that minimum upside target than I have allowed in gold.
What's going on with lithium? The prices in China have just gone crazy so far this year.
Well, lithium is responding, as I read it, entirely to the fact that I owned a lithium stock with the symbol LITOF, and I got so bored holding on to it that I sold the stock. That has been instrumental in having it take off like a bat out of hell. And, I was hating it down there, this particular stock at 50 cents. And of course, as we speak, it's trading at 4 times that price. So lithium is simply reacting to my sale of that stock.
Inflation in Canada, the U.S., around the planet is going crazy. Levels we haven't seen since the late 70s. Is this going to continue for quite some time?
No, it will not. I would say enjoy this inflation while it lasts, because the deflation that's going to follow when the stock market finally breaks and we have an asset collapse, a deflation, is going to be hideously worse than what we're experiencing today in inflation in virtually every area of the consumer economy. So just enjoy it while it lasts. And you can see that besides the deflationary bust that's coming, there's a kind of a natural limiter on the inflation. When you get cars up to levels where people say, hell, I can't even afford a used car anymore, so I just won't buy it. Or when gas in the U.S. is up at $5 and higher, you're really at that threshold where people stop buying stuff, and the cessation of demand will have an impact on prices. But that said, I'm really kind of surprised at the latest consumer spending figures, where they suggest that everybody is kind of in who the hell cares about inflation mode. They're just buying everything. They're just paying up for everything. I know that's true where I live. The prices on all the menus are much higher than they were, and you can see that a lot of people, a lot of vendors, retailers who sell things are using the inflation story as a cover to jack prices more than would be justified by the increase in costs that they may have incurred.
Well, we've noticed a liter of creamer for your coffee is now 9.46 milliliters. The carton looks like it's the same size, but you're now getting less, and they're charging you more.
The Wall Street Journal had a good story about that. The kind of shrinkage deception that's being perpetrated everywhere. All the packages you get, all the vitamins I buy and health supplements, the containers are like 3 times what's needed for the contents. So this is happening. There's no such thing as a 16-ounce pound anymore. Everybody's getting 12-ounce packages, and they've shrunk the width of toilet paper rolls, and it's happening everywhere. And it's not like we're fooled or anything like that. But I just hope that someday the perps, the companies that are ramming this, or even worse than the inflators, the ones who are trying to cheat us, I hope they all get strung up in the public square.
Well, here in British Columbia, the provincial government once again is going to inquire about high gasoline prices. And they said, well, last time we did that, there was 10 cents a liter we couldn't account for. But it turns out it's these secret carbon taxes that governments, both federally and provincially, keep sneaking in. And the inquiry wasn't allowed to ask about the impact of taxes. And in Vancouver, we have the highest gasoline prices in North America. We were paying nearly $1.83 a liter, or $6.95 per U.S. gallon. Wow. So, yes. So, and again, most of that is tax. We have a transit tax that's also imposed on the gasoline. I think it's 18.5 cents per liter. And then the federal government cheerfully adds the goods and services tax, the GST, on top of the taxes that are already being made. And when the government brought in the GST, of course, they promised we won't tax a tax. But they are. So the higher the gasoline prices go, the more money the government makes, so they're happy about it.
Well, I find something encouraging in what you just said, because as we well know, nothing slams the brakes on inflation like a good old-fashioned inquiry.
Oh, yeah.
So we can all be hopeful that if the inquiry is pursued, that we'll see a quick end to this inflation.
Mm-hmm. Now, Now, last time we had inflation like this, interest rates skyrocketed as well. I remember the 1981 issue of Canada Savings Bonds paid 21%. And I scraped together every penny I could to buy as much as I could. And, of course, I was only making $1,300 a month, so it wasn't a lot. And yet, with that kind of an interest rate, it did pay for my wife's master's degree at the University of British Columbia.
Great.
Yeah.
Good. That's
so are they going to boost interest rates to try to wrestle down inflation, or is the cure for high prices, and the Fed is just deluding itself and everyone else by thinking interest rates will bring it down?
Well, you say they,
yeah,
but as far as what they're going to do, what have you noticed over the last 30 odd years since they were going to put the kibosh on inflation? Well, I remember Lyle Gramley back in the early 1990s saying, you know, if all the monetization or the bailout from the S&L crisis is going to create more inflation, the Fed's going to jack rates. But the one thing that was hard not to notice over the last 30 years is that the actual times when they've raised rates has been, for all the talk, they've only done it a couple times, like 1/100% of the time they're actually raising rates over the duration of when they're saying they're going to raise them. All right, so it's even less likely now because, and you'll notice that how long do we talk about this rate increase and how, well, now it's going to happen in July or whatever. The Fed has no desire to be the villain here. I think they suspect that the economy, that the whole asset bubble is about to collapse anyway. So do you think they want to raise rates and be directly associated with the collapse that would trigger the collapse that's coming anyway? The Fed move to tighten would just kind of ice the whole thing or ace the whole thing, and you know, we'd have a deflationary collapse right away. So all the Fed does is blather and quote unquote manage our expectations, and of course they've done a beautiful job because the people doing the expecting seem to have IQs of about 60. They've heard it all before, and I guess to be fair, to look at it another way, when the Fed says something that's construed as either hawkish or dovish on rates, it's not as though everybody really does believe them. They just know that the idiots who run the central bank are just doing their old blathering managing of expectations. So the market's reaction is not so much a belief that causes prices to go up or down, a belief in what the Fed's saying, but the fear that the idiot that you compete against in the portfolio, the hedge fund down the street, or the pension fund, they're going to react to the Fed news in the way that you would predict they would react. So everybody's sort of looking at each other and thinking, well, if there's even a slightly dovish pronouncement from the Fed, I've got to buy the market, not because the Fed isn't the usual bunch of hacks and charlatans saying what they do, but because you're worried the other guy, you know how the other guy's going to react. So that's what causes these wild gyrations on announcements from the Fed.
We're expecting another spring of just a frenzy of first-time buyers trying to get into the real estate market, which has jumped tremendously in most places in Canada and the U.S., and the real estate agents are saying the supply is shorter than ever and prices will be crazier than ever. What's your view?
Well, that's sort of raising the possibility of a real estate bust from 99.3% to maybe 99.7%. We've got it ongoing here. You know, my Florida condo has tripled in value off a low appraisal from probably less than 3 or 4 years ago, and it has to do mainly with limited supply. There's no availability of my particular type of. I live in a villa type structure, and it's popular, but there's just none of them for sale. So everybody's paying up right now, but you can see the big players who paid up. And this is something we've talked about before. We've got so much spec buying of real estate by companies like Zillow, for one. Zillow now is reporting losses up in the $250 million range. And that's a huge bust waiting to happen, because all the private equity companies that knew nothing about real estate went into residential on a speculative basis. And two things happened. They did not care how much they paid for these homes. And I know that because a friend of mine worked for Zillow, and they gave him a blank check to go in and buy half of Denver. So anyway, they pay up for the properties. They're buying, if it's not the top of a real estate bubble, it's certainly very close to it. And then when they refurbish these places so that tenants can occupy them, they don't care how much they spend. Why? Both of those things true? Simply because their bean counters are saying, look, we're going to do a 10-year accrual here, and 10 years out, even with just mild inflation, we'll make out just fine. So here they are buying the top of the real estate market and being really extravagant with refurbishing the places so that they can rent them. And you don't even have to ask the question, where's all that going? So we're going to have a huge bust in real estate, and of course none of these private equity companies that have jumped into real estate have ever experienced the kind of economy where tenants are hard pressed to pay. And the joke of it all is that these homes are being rented to people who manifestly cannot afford to buy their own homes. So you tell me, where's all that lead? I just, you can't get around a very dire, scenario.
Well, I also recall back in 1981 in the small town of Moose Jaw, which is just outside of Regina, Saskatchewan, developer, when, mortgage rates had hit 18%, couldn't find anybody to buy these 6 houses that he had built. So he took a bulldozer and started demolishing them. The 6th house he had occupied, his wife was in the kitchen busy and didn't notice he was about to bulldoze that house as well with her inside of it. And he only stopped when police put a bullet through the window of his loader.
Wow.
Yeah, so we had disaster tourism there. People came from miles around to come and take a look at the small part of the subdivision that had been bulldozed because nobody could afford to buy those houses. I'm sure we may not see that kind of insanity, but I'm sure there are some developers who would be tempted to do that. Or there might be mysterious fires.
Well, the developers are nothing if not relentless.
Now, oil, are crude prices going to remain high, or have we seen a peak? Again, I guess it all depends on what happens with Russia, Ukraine.
Well, the April NYMEX right now is trading at $90 a barrel, and I'm looking at a minimum 105 here. Basis the April contract, I've got a projection. Oh, actually, 101.88. is where I think it's going at a minimum. I want to watch closely there because that could be a place where the oil spiral could reverse.
Rick, anything else we should be keeping a close eye on right now?
Yeah, Allegiant Airlines. This just in, they just ejected a passenger from a plane because he had a Let's Go Brandon mask. So I guess the world is still not safe for all of us Let's Go Brandon types, and believe me, there are a lot of us out there. So just be careful if you get on an airplane. Don't wear a jacket over your Let's Go Brandon T-shirt if you want to reach your destination.
Yeah, so much for free speech.
Yep.
Rick, thank you so much for being on This Week in Money.
Always enjoyable. Jim, I thank you for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He was speaking to us from South Florida. Our conversation took place February 17th. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Rick Ackerman. And thank you for listening. If you have any questions for our guests or the show, you can send them to info@howstreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Thank you, Jim.
Larry, I saw a pretty impressive video of your demonstration recycling plant, and you also had a news release earlier this week. What can you tell us about both of them?
Well, the video is of our shredder, and that shreds the, basically the aluminum, and we are able to get the cathode material off the aluminum, so that's working very well. And but our major thing was the press release talking about our demonstration plant and some of the layout in it, and you can see by the size of the equipment, this is not a small dinky toy plant. It's got some impressive sizes in there. So it's I'm just waiting for the piping and the wiring to catch up, and we'll have another update. Now, what it does show you that this could actually be a commercial plant down the road, and that's what we're shooting for, is to try to make what we're doing commercial and getting buyers for the material we produce. Certainly, some of the material is from the Tier 1 companies that we have NDAs with, so those will be small batches. But the major portion of our plant is the 5 tons we got to put through the plant, and 500 kilograms a day, and we hope to be able to turn that into some actual money. And if we can, we may move the plant to another location where it can be operated continuously, and we'll have a small bit of cash flow coming in.
Larry, the demonstration plant and your patents, how impressed are Chinese investors with the efforts that you've made, because electric vehicles are the big wave in China?
Well, China leads the wave. They lead the wave in everything. The product that you need for the cathode materials, the nickel, manganese, cobalt, and they certainly lead the chemistry on building batteries. China's a way out in front here, and what we're hoping to do is shortcut some of the things that they're doing and put this demonstration plant next to a battery production plant that we can turn around the material that goes out into scraps back into usable material or usable batteries with even better performance than the originals. So it's an exciting chapter in our life, and we're going to see things starting to come together, and it's going to change the whole dynamics of the company. I think that some of these NDAs may be turned into agreements, sometimes towards the second part of this year or third part of the year, and everybody wants to see this thing actually operating on a commercial basis. So, it's a exciting chapter for us.
I know that not so many shareholders as such, but it seems like the emphasis is on, even for Stockwatch, the emphasis is on the fact that they're not proceeding with the second phase of the testing, although they've got nothing wrong with the science, nothing wrong with that. It was the cost. But, these things cost money when you're doing it on a R&D basis. You got to factor that into the cost of the whole operation. So, the reality is, Jim, that I think that the U.S. needs this. They need to be able to produce manganese, especially on an emergency basis.